Hello everyone. Chart patterns don't work. At least, not the way you've been taught. You've probably memorized these 6 shapes: flags, triangles, head, and shoulders. You've saved the cheat sheet. You've drawn the lines. And yet, you keep getting trapped. The pattern confirms, you enter, and the market reverses straight into your stop. Sound familiar? Here's the problem. You're reading geometry when you should be reading the auction. A chart pattern is not a shape. It's the visible footprint of a fight between buyers who want higher prices and sellers who want lower ones. When you understand that fight, who's trapped, who's being forced to exit, and where the pressure is building, you stop guessing and you start reading. In the next few minutes, I'll take you inside 6 of the most powerful price patterns and show you exactly what's happening beneath the surface. Not shapes, mechanics. And pattern number 6, the one most traders completely ignore, might be the most powerful signal on any chart. But to understand why, you need to see what's really happening inside the first 5. Let's start over. Before we touch a single pattern, you need to understand the engine that drives all of them. Every candle on your chart is created by 2 forces. On one side, you have patient traders. They place limit orders and wait. They provide liquidity to the market. They're the supply on the shelf. On the other side, you have impatient traders. They hit the market button and execute right now. They consume that liquidity. They're the shoppers grabbing from the shelf. When impatient orders overwhelm the patient orders at a price level, the price moves. That's it. That's the entire engine. But there's a third force. And this one changes everything. Stop orders. A stop order sits quietly until price reaches it. Then it triggers and becomes a market order. Forced execution, no choice. And here's the critical part. When one stop triggers, it can push price into the next stop, which triggers the next and the next. It cascades. This isn't theory. Regulators document this phenomenon. Research confirms it in real markets. Stop cascades are mechanical, and they are the hidden fuel behind most of the patterns you're about to see. One more piece of the puzzle. Where do all these orders tend to cluster? At obvious levels. Prior swing highs, swing lows, round numbers. That's not coincidence. That's why support and resistance work. There's literally more resting liquidity at those prices. Now you know the engine. Let's see what it builds. Pattern number 1, the flag. Most traders learn that a flag is a little channel after a strong move. That's like saying a car is a metal box with wheels. Technically true, but it tells you nothing about how it works. Here's what a flag actually is. It's the market asking a question. Is there enough supply to reverse this move? And the answer is no. After a strong impulse, a big fast move, the market pulls back. That pullback attracts sellers. Short sellers jump in, expecting a reversal. Profit takers exit their longs. But here's the key. If those sellers cannot push price down significantly, if the candles get smaller, the pullbacks get shallower, and the range starts tightening, then the selling is being absorbed. Think of it like a sponge. The market is soaking up every sell order that hits it, and the sponge is not getting full. That's compression, and compression stores energy. Now, when price breaks above the flag boundary, 2 things happen at once. Fresh buyers jump in, that's momentum. And the trapped shorts? They have to cover. Their buy-to-close orders are forced, not discretionary. That forced covering is like rocket fuel. It's non-negotiable buying pressure that accelerates the move. But pay attention to how price breaks out. You want to see a strong close near the candle high, a wide body, not just a wick poking through. That's acceptance. A wick that pokes above and closes back inside, that's rejection. After you start recognizing that difference, breakouts will never look the same to you. But what happens when a flag breaks down instead of up? When the dominant side turns out to be not dominant at all? That failure isn't a loss. It's information. And it connects directly to the most important pattern we'll cover later. But first, pattern number 2. Pattern number 2, the rectangle. If a flag is the market saying not enough supply to reverse, a rectangle is something different. It's the market saying, we agree. Buyers and sellers have found a zone where two-way trade is comfortable. Price pushes to the top, hits supply, comes back down. Pushes to the bottom, hits demand, comes back up. Over and over. This is balance. Neither side is winning. But balance doesn't last forever. And when it breaks, pay attention, because what you're witnessing is a liquidity event. Here's what that means. One of two things happened. Either the resting orders at the edge got consumed, aggressive orders ate through them faster than they could be replaced, or the limit order providers simply stepped back, pulled their orders, created a vacuum. Either way, the result is the same. Price walks through the boundary because there's nothing left to stop it. Now here's where rectangles become really interesting. The retest. After a breakout, price often comes back to the broken level. Most traders panic when they see this. Is it failing? But a high-quality retest is actually proof. It's the market confirming that the old resistance has become new support. You want to see rejection wicks. Price tries to go back through the level and gets pushed away. Strong closes back above. That's the market saying, we tried, we can't go back. This is the new value. But what about the traders who were fading the range? The ones who kept selling the top? Once you understand what happens to positions after a true breakout, you'll see why retests hold. Those trapped sellers become forced buyers, and their exits fuel the continuation. Now, if the breakout fails, if price punches through and then snaps right back inside, that's not noise. That's a trap. And the breakout traders who just entered, their stops become fuel for the reversal. Did you catch that? The same four-part anatomy, hiding inside a completely different shape. Pattern number 3. Triangles. Forget converging lines. A triangle is pressure building against a wall. Take the ascending triangle. Flat top, rising lows. Here's what that structure is really telling you. The flat top is a known supply zone. Sellers keep showing up at the same price. But look at the other side. Buyers are getting more aggressive. They're bidding higher each time. The lows keep rising. That's absorption in slow motion. Each time price pushes into the ceiling, some of that supply gets consumed. Sellers fill orders and leave, or they pull their orders because they see the pressure building. The wall is getting thinner, even if price hasn't broken through yet. Now flip it for the descending triangle. Flat floor, falling highs. Supply keeps arriving sooner. Sellers are getting impatient. The demand at the bottom is being tested and tested and tested. The key question with any triangle is, are you seeing real compression or just time passing? Real compression looks like swing sizes shrinking, wicks getting shorter, the market coiling tighter, like a spring being compressed. You can almost feel the energy building. A lazy triangle, wide swings, long wicks on both sides, no directional pressure. That's not storing energy. That's just choppy price action going nowhere. When the boundary finally breaks, the fuel comes from the same place it always does. The trapped edge defenders, the traders who kept fading the ceiling or floor, they must exit. Their stops trigger, and those stops can cascade into momentum. Now here's something most traders miss. Triangles bust. Often. A breakout that can't hold. A wick above the ceiling that closes back below. That's not just a failed pattern. It's the market telling you that the dominant side was an illusion. And when that reversal comes, it can be sharp, because now you have trapped breakout traders and trapped edge defenders, all on the wrong side. That's maximum forced flow. Most pattern tutorials stop right here, but the next one changes everything about reversals. Pattern number 4, head and shoulders. This pattern has been around for over a century, and it endures for one reason. It tells a complete story, not 3 peaks. A story of demand dying. Let me walk you through it. Left shoulder, the trend is still strong. Buyers push to a new high, price pulls back, and bulls are in control. No problem. Head, buyers push even higher. A new top. But then, the sell-off is deeper. And here's where the first crack appears. The buyers who entered at the top of the head, they're immediately underwater, right shoulder. The market tries to rally again, but it can't reach the head. It falls short. That failure is the entire signal. It means buyers can no longer sustain higher prices. Each rally attracts fewer participants. Sellers are arriving sooner. The demand side is exhausting itself. Now the neckline. This is where buyers previously stepped in and halted every decline. It's the floor of the story. When the neckline breaks by close, not just a wick, a decisive close below, it tells you that floor no longer holds. The demand that was there, it's been consumed or it's walked away. And then the cascade begins. All the late longs, the ones who bought near the head on optimism, the ones who bought the right shoulder as a dip buy, they're all trapped. Their stops cluster below recent swing lows. And when those stops trigger, forced selling, market orders, the same stop cascade mechanic, now powering the entire breakdown. But here's the counterintuition. What if the neckline breaks and then price reclaims it? What if it pushes back above the right shoulder? When you see that happen, the pattern hasn't merely failed. It has revealed hidden demand that nobody expected. The shorts are now trapped. Their covering becomes fuel. Some of the strongest bullish moves I've seen come from failed head and shoulders. The crowd positioned one way, and the market did the other. And the market's purest memory structure is next. Pattern number 5, the double top and double bottom. These are the market's memory structures. The shape is secondary. What matters is this. The same price zone produced the same reaction twice. A double top forms when price reaches a high, pulls back, returns to that same high, and fails again. What's happening mechanically? At those prices, supply is sufficient to absorb demand. Not once, twice. The market is telling you, this is the ceiling. We tried. We can't get through. A double bottom is the mirror. Price hits a low, bounces, comes back to that low, and holds again. Demand absorbs supply at that zone. Twice. Now the confirmation isn't the second peak or trough itself. It's the break of the midpoint, the neckline. For a double top, when price breaks below the swing low between the two peaks, it means the buyers who supported that middle level have given up. And the traders who bought the second top, they're fully trapped. Their stop exits add force to the breakdown. But here's the most valuable insight about doubles. A failed double top is one of the clearest bullish signals you can find. Picture this. Price forms the double top. The neckline breaks. Shorts pile in. And then price reclaims the neckline, pushes back up, and breaks above both peaks. That failure just trapped every short seller who entered on the breakdown. Their covering is forced buying. And if real demand is behind the move, the breakout accelerates. Researchers have studied this exact scenario, the busted double top, and found that the reversal move after a bust can be significantly larger than the original pattern's expected move. Now, remember what I promised at the beginning? We're about to get there, and it's going to flip your entire approach to reading charts. Pattern number 6. And this is the one that changes everything. Failed breakouts. Every pattern we've covered has a failure mode. Flags break the wrong way. Rectangles fake you out. Triangles bust. Head and shoulders reclaim. Doubles reverse. Most traders treat those failures as losses. Bad luck. The pattern didn't work. But what if I told you that the failure is the signal? Here's what a failed breakout really is. It's a failed attempt at acceptance. The market moved beyond a boundary, a range edge, a trend line, a neckline. It tested new value, and the market said, no, not here, not now. What happened mechanically? Either aggressive orders consumed the nearby supply but found deeper supply above, or liquidity providers pulled back briefly, allowed the breakout, and then re-entered. Or, and this is the most common, the breakout was driven almost entirely by stop triggers. There was no real follow-through participation. Price comes back inside. The auction has spoken. And here's the key. Every single breakout trader who just entered, they are now trapped. Their stops are inside the structure they just broke out of. When those stops trigger, dominoes. The very traders who created the breakout now fuel the reversal. Their exits become the momentum for the other side. This is the meta pattern. It works on every pattern we covered. A busted flag becomes a reversal trade. A busted triangle becomes a sharp move the other way. A busted double top becomes one of the strongest bullish signals in the market. And once you understand this, really understand it, you are no longer a pattern trader. You are an intent trader. You stop asking, does this match the textbook shape? And start asking, what is the market trying to do? And is it succeeding or failing? This is what I was talking about at the beginning. Failure isn't a problem. It's privileged information. Because a clean failure often reveals more than a clean success. Success can be normal trend behavior. But failure reveals hidden liquidity and positioning imbalance, trapped traders on the wrong side. And that is the most exploitable condition in any market. Now let me tie everything together, because you don't need to memorize 6 patterns. You need to internalize 3 questions. Question 1. Where is liquidity likely resting? Look at your chart. Where are the obvious swing highs, swing lows, round numbers? Those are the magnets. That's where orders cluster. Limit orders, stop orders, conditional orders. The market is attracted to those levels because that's where the crowd makes decisions. Question 2. Who is being forced if price moves there? If price breaks above a resistance level, who has their stops just below it? If it sweeps below support, who is being stopped out? And will those forced exits create enough flow to sustain the move, or just enough to trigger a trap? Question 3. Is the market in balance or in price discovery? Balance means two-way trade. Both sides are present. Price oscillates. Price discovery means one side has overwhelmed the other, and price is moving directionally with closes in the same direction. These 3 questions work on any chart, any time frame, any market, because they're not about shapes, they're about the auction. And here's the mental model that holds it all together. Every market goes through the same cycle. Balance, pressure builds. The boundary gets tested, either acceptance or rejection, expansion, and then either exhaustion or continuation, back to balance. Every single pattern we covered today is just a different skin on that same loop. Flags, expansion, then controlled balance, then continuation. Rectangles, balance, then acceptance, then price discovery. Triangles, tightening balance plus pressure against a wall, then resolution. Head and shoulders, exhaustion plus failed continuation, then reversal. Doubles, failed extreme, then acceptance the other way. Failed breakouts, rejected acceptance attempt, then reversal expansion. Same engine, 6 different shapes. Once you see the loop, you'll never look at a chart the same way again. Let me be honest with you for a moment. Watching this video once won't make you a pattern expert. Understanding the mechanics is the first step, but it takes screen time to internalize. But here's what you have now that you didn't have 20 minutes ago. A framework that works everywhere. Not 6 shapes to memorize, but 3 questions to ask. Not, does this look right? But what is the market actually doing? The next time you see a flag, you won't just see a channel. You'll see absorption. You'll see trapped shorts. You'll see compression ready to release. The next time a pattern fails on you, and it will, you won't feel frustrated. You'll recognize it for what it is, privileged information. And once that shift happens, when you stop seeing shapes and start reading intent, trading changes. Not overnight, but permanently. Don't just watch this once. Save it. Come back to it after your next trading session. I promise the second time through will hit differently. Until next time, read the auction. I'll see you in the next video. Stay disciplined.